Welcome to my channel. I'm the cover call guy, and I only do cover call ETFs. If you're new, I'm trying to reach my goal of $120,000 a year using only cover call ETFs. Um, this video is about the 2025 income playbook for drawdown strategy. I've noticed that a lot of people, my subscribers, viewers, and people that leave comments are in a much higher yield than I am. My portfolio is about 10-15%. And I've noticed a lot of people are like 50+% in their um, portfolios, and they're leaving comments saying, I'm yielding 50%, but my account balance is shrinking. So this video, I'm just going to try to break down the high yield income fund drawdown playbook. Right, it's going to be like a strategy for navigating market pullbacks. We're going to be um, explaining why not all price drops are created equal, and you're going to learn how to buy and look at buying opportunities. Right, just because it's a pullback doesn't mean it's going to be a value trap. You just have to understand that your extra ultra high yields are not always going to be in favor. So you don't have to necessarily sell it, but you want to start transitioning those profits that you get every month and start buying a little bit more stable cover call ETFs. But before we get started, legal disclaimer: this content is for informational and educational purposes only and is not financial advice. I'm not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risks, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I am just some random idiot you found online, and I could be completely wrong. Now, with that out the way, let's get started on today's video. The high yield income fund drawdown playbook, right? My guide to navigating a market pullback. And for those who are new, just watching this video, and you guys are an ultra high yield fund, and that's all you have, and you come across, what kind of cover call ETFs to buy, I'm going to start with the very basic in my first few slides, explaining everything, and then we're going to start moving on. And welcome to the channel. All right, evolution of income investing, right? Moving beyond traditional dividends. Because I was a traditional dividend investor, just moved into options income, cover call ETF slash income investing. So let's explain what traditional income is. Traditional income depends on company profits, right? So it's very different from dividend investing to cover call ETF slash income investing. Modern option income depend on the volatility fair, which is the VIX. This means you can get paid on high yield even if the stock price stays flat, because traders are paying you for insurance via option premiums. So right now, we're not really in a strong bull market, even the market all-time high. We're seeing the market dip, right? So that kind of affects your stock prices and sometimes your premiums, especially for these ultra high yields. And then we have the timing trap. The risk is upside capture. If you sell a call, not you specifically, maybe the ETFs, but if you are doing it, then you. If you sell a call and the market rips higher, your gains are capped. To win, you must capture the good days to offset the bad days. If you miss the rally, you are left with only the risk. So we got to understand, um, the difference between option income and dividend income. And then, of course, with option income, you do have some timing risk to this, the timing trap. All right, and then of course we got to understand the taxonomy of option-based income funds. We have the systematic core, which is index-based monthly cover call with spreads, SPY, QQI, IWMI. They yield about 10-14%. Tactical zero-date time expiry. Daily options capturing overnight / intraday premiums. QDTE, XDTE, or DTE, which is about 15-40%. And then we have the volatility satellite, which just means like you don't really have to own these. These are just more of kind of like to help boost your income by a little bit and your yield, but they're not like your core. These are short VIX futures until hedges. Example is SVOL, about 15-18%. And then we have the single stock aggressive. These are the high yielders, right? These are the ultra high yields, and these are the ones you mainly have to kind of start focusing on and start worrying about in a very prolonged downturn drawdown market. These are the synthetic replications plus high IV option writing, and some are TSOY, NVDY, AMZY, which can yield about 40-100+%. And then, of course, to sum it all up, not all yields are created equal, as you can see, right? The top first and the the third one, even if their yields are similar, they're not the same, right? They have very, very different strategy, underlyings, fund management, execution behind them. And then, of course, the tactical with the single stock, even if it's up to 40%, it won't be the same as how they get their 40%, right? So core funds offer stability, 10 to 14%, while the super aggressive funds like with the 40 plus or riskier bets pick the tool that fits your risk tolerance. So it's all about understanding how much risk you can take, especially in a drawdown market. And then a tax alpha strategy, right? We have section 1256. I'm going to explain it. Um, Fund index options, NDX, SPX get a 60-40 tax split. The biggest fund that does this is NEOS. And then we have constructive return of capital, right? Is a tax deferred tool. Doesn't mean you don't pay taxes, it's just deferred. It's pushed to the future, right? Is an interest-free loan from the IRS, basically, right? You pay zero tax on the income today, you only pay when you sell the fund years later. Or if you never sell, then you might be able to get away with paying nothing. All right. Yield equivalent for high bracket investors, like hopefully myself soon in the next 2 or 3 years, as I'm trying to achieve a $120,000 a year minimum a year. A 12% tax efficient yield puts the same cash in your pocket as a 15% ordinary yield, but with much less risk. All right, the core portfolio foundation, stability and consistent yield. All right, systematic core. I choose the NEOS framework. Maybe you think the same. And if you're new, I always try to guide people towards NEOS if you're new cover call investors, because why? They have the call spread strategy. SPY and QQI buy higher strike prices to create a bull call spread. This uncaps potential buying upside during rallies, unlike rigid at the money strategies. Two, performance dynamics, right? QQI captured 60 to 70% of NASDAQ upside while paying a 14% yield, avoiding NAV decay of first gen funds like QYLD. And third, small cap diversifier, IWMI, right, is the Russell 2000, capture highest premiums from their small cap volatility, or offering 14 to 15% yields with active management. And then we have the daily set advantage for those who are interested, right, from ProShares, iSpy, Daily Mechanics. All right, they use swaps. What are swaps? A swap is a contract between fund and the bank. The fund gets the SP 500 daily return and pays the bank a fee while collecting option income. The pros of this: the daily reset capture rallies every single day. If the market goes up, the fund participates immediately, solving the missing out problem. However, the con is that counterparty risk, relying on the bank's solvency, and typically higher internal fees than owning stocks directly. So, of course, some people like the daily reset. Some people say, you know what, it's too much of a headache. I'd rather not because of too much risk that involves swaps. Aggressive and tactical yield sources, harvesting volatility with zero date expiration and synthetic strategies. All right, the tactical yield, right? The zero date expiration risk explained, understanding the dangers, which is one, gamma risk, the whip, basically, right? Think of it as a whip. 0 day expiration options react violently. For example, if the market rallies 2% in the last hour, the short option lose massive value instantly, forcing the fund to buy high and lock in a loss. There's no way out for this for them. They have to do it. It's by a contract, they do it, and you basically is guaranteed to lose if it does that. The gap risk, the drop. Example, if a war breaks out overnight, the market opens 3% lower the next morning. Since the fund hold position overnight, it takes the full loss before it can reset. And 2025 has been a wild year. I know there's about a month left, but it has been a wild year. So you don't know. Right? Anything can happen. This is the risk you have to take. However, they do pay out a lot higher yield, which is not always guaranteed, right? It might eat away at your NAV, but high risk, high reward. Aggressive growth yield, right? Specific company risk. Single stock versus basket, relying on one company like Tesla for TSLY for Tesla is dangerous. If that specific CEO tweets something bad for missing earnings, you have no safety net, right? And Elon Musk has been kind of known to be a little erratic at times. Your income is tied to one stock's luck. And what happens if he passes away or something, right? It's his entire image is tied to that company. The basket solution, you can go for FEPI or AIPI. Owning a basket of 15 companies spreads the risk. If Tesla drops, but NVIDIA rises, your funds at least stay somewhat stable. This reduces the chance of a total wipeout while still paying 25% yield. Risk control and optimization, right? Diversification, hedging, and tax strategy. Global and volatility diversification. We want some international income. Why not? You don't have to, but why not? IDVO, the quality, right? They hold the quality international income, active management, focusing on global balance sheets, lowers portfolio beta and captures value factor, right? You don't want beta is basically how volatile your portfolio is going to be. So we base that off a number one, depending on SPY or not, the SP 500 or Nasdaq, depending on what your portfolio really holds. So if, SP 500 or Nasdaq, the they are always one. So if your portfolio is below one, that means it's not really going to be swinging as much. If it's 1 for 1, that means if Nasdaq goes up, you go up. If the Nasdaq goes down, you go down. If it's over 1, then it's a lot more volatile than the SP 500 and the Nasdaq. So you will swing up higher, but you will also swing down lower. And then we have EACC slash EMCC. These are the regional harvest volatility premiums from developed EAFE, which is basically Europe, Australia, and I think FE means Far East. I could be wrong on that. Oh crap! Why didn't I put that in? I think that's what it means. And emerging markets, hedging against USD weakness, right? So the world right now runs on USD, runs on the American economy, and right below that is China, and right below that is the top 5 global economy. For the most part, it's just 2 countries. So you want some international and regional coverage just for safety net. Personal opinion, you don't have to. If you're an American and you have the chance to just do American companies 100%, there's nothing wrong with that too. You just take on a little bit more quote unquote risk. Volatility satellite. This is a SVOL. This is the hedge. Short VIX futures to harvest roll yield 16%, but buys deep out the money VIX calls. Proven resilience during the August 2024 yen carry unwind. For those who know, for those who don't, just Gary, just Google. Sorry, not Gary. Google yield carry or just YouTube it, and it'll explain what that is and how it affects the global economy and the U.S. stock market, right? And this outperforming unhedged strategies. And then we ask, why is this needed? If the U.S. tech market crashes, your core fund will drop. International and volatility funds often move differently, acting as a safety buffer to keep your income flowing, to keep your income a little bit more stable and predictable. All right, tax loss harvesting pairs, right? We have the NASDAQ, SP 500, single stocks, right? These are just examples of primary ticker, QQI, and then we have the partner ticker, which I think is JEPQ, SPY-I, partner ticker, GPIX, TSLY, partner ticker, TSLP. The benefit, swapping a losing fund for a similar banks a tax loss to lower your tax bill today while keeping your money invested and working for you. So, you don't have to. This is just examples. I mean, like if it ever happens, right, then you would swap. But QQI has been solid, JEPQ has been solid. They're just like kind of intermediate with each other. They kind of move along with each other for the most part, right? SPY-I, GPM, they do pretty much do the same market universe, to so to speak, like the SP 500 and Nasdaq. So these are just kind of like 1 for 1, holding pretty much the same thing, with the exceptions of this one is QQI is a little bit more tax efficient than JEPQ. All right, the income shield allocation, right? Core income 40%, tactical 20, aggressive growth 15, volatility hedge 15, international 10. How this protects you? Balance is key. Tech crash, core holds up. Flat market, tactical plays. Volatility spikes, hedge pays. No single event wipes you out. Again, I made this slide for more of the newbies, the newer people that are just getting into cover call ETF / income investing. This slide is for you. I think this would be the best approach, especially if you're new and you're nervous and you're not sure where you want to go. Your core could even be 50% or 60%. Drop this tactical to 10. Aggressive and volatility drop to 10, 10 each, and move it on to core. But this is just an idea of how you could kind of build your portfolio around. Um, and if you're thinking about it, if you're very anxious or not sure, you read too much of the Reddit post or whatever whatever goes on X or YouTube saying, hey, don't do this. If you're I'm in my early 30s. If you're in your early 30s or even younger, it just depends what your goal is. So this kind of protects you with everything. It's basically the growth shield, but this is the income version. So for if you're kind of nervous, this is pretty solid. You're covering all bases. You're not really this is kind of almost a set and forget, right? I mean, for the most part, you can lower your tactical and your aggressive and volatility hedges and put more into your core income. And I'm in the previous video before this, I have my top 11 picks of my core income, so you can just go 100% into that core income, and it plays out pretty well. All right, drawdown management protocols. All right, this is for the newbies again, the new ones that are just getting into this space, and or just thinking about it. I hope this video has influenced you. Um, Perhaps you're in the same situation I am. I'm in my early 30s, not trying to replace my 9 to 5 salary, right? So, yield trap filter, right? You have to filter out the yield traps. If NAV declines more than 10% over 6 months while the index is flat, place the red alert on it, right? Erosion continue, rotate the capital to the core. I always say if the bear market is about a year and your stocks go down for a year, okay, that's not really a yield trap, right? However, now you test the next year or so and there's a raging bull market and your stock, your NAV hasn't grown, your payout has still dipped, then you might want to start putting a red alert on it and start maybe rotating into a more core cover call ETFs. You don't have to necessarily sell it. I mean, you could sell it if it's a huge position, but if it's still paying you out, might as well just keep the cash coming in and push it into a core position and start building up a core position. And then we go on to number 2, rule of cash. Do not drip aggressive/tactical dividends. Take the cash, use it to buy core international sleeves if they are below target, especially in a drawdown market. Do not reinvest into a losing battle here. I might get hate for that, but I truly believe you should not be doing that. Do not drip into aggressive tactical dividends in a drawdown market. In a prolonged bear market, rotate into core positions. And of course, stress testing, right? Test against 20% volatility spikes. Tactical sleeves may draw down. Core sleeves dampen via spread. Liquidity allows rapid redeployment. My new investor advice: start slow. Don't chase the highest numbers you see. Stick to the rule of cash. Take your risky profits and move them into safe assets. This locks in your wins. You don't want to double down on losses and think it's going to shoot back up, because if the market doesn't, you are screwed. Looking ahead, what to expect in the coming markets. This is, of course, going to be my kind of guess. Market outlook, right? It's going to all depend a lot on the interest rate. If rate drops, bond yield fall, investors rush into high yield ETFs to replace the income, driving up the share price of your core funds. Volatility levels. If market fear is low, option premium strength, your yield might drop, but usually stock prices are rising, so your portfolio value grows, especially your core. Tax changes. Of course, we'll never know what's going to happen, right? It could change within next year, 2 years. If capital gains increases, the Section 1256 tax alpha of funds like SPY becomes even more valuable, saving you more money. And then I quote, I really like: yield is not a return, it is a compensation for risk. Translation: a high yield means high risk. Never assume a 50% payout is free money. Manage risk to earn your return. Take this to heart, especially to the new investors, because you are basically gambling if you don't take this serious with all these ultra high yields in a prolonged bear market. And that's it. subscribe, comment, like. I appreciate all the love, all the support. I hope this video has helped a new income investor, cover call ETF investor. If you're just on the edge, I hope I've guided you towards joining the community, the group. Thanks for watching. I appreciate the support, the comment, hate or love. I appreciate it all. Stay tuned. Catch you guys in the next.